All right. Thanks for coming, everybody. It's early morning, so we promise to do our best to have a lively discussion. My name's Alex Friedman, and it's a pleasure to be your moderator today. We've got four very accomplished and experienced panelists in this space. So before I introduce them, I just want to put a tiny bit of context around the discussion. The title is The Rise of Social Capital Markets and How They're Going to Change the World. I don't know what exactly that means. That's the first point. The second point is if you go back in time and say, well, when did philanthropy begin? You could argue about it, but you could say it began with Catholicism, or you could, where the idea was, you do something positive for somebody else and it will be returned. But maybe that's not real philanthropy because you're getting something back. Maybe it was the Stoics. Maybe Marcus Aurelius was a big Stoic who was known for this. The issue I see is that if you go back those thousands of years to the present, philanthropy has grown a lot, but it's kind of flatlined. The US is the most philanthropic nation in the world, and because we're not growing so much right now, philanthropy is not growing so much right now. Whether we grow at 2, 2.5, or 3% GDP in the US, it's still sub-trend growth. At the same time, problems are bigger than they've been before, and governments are spending less. So there's this crying need for some kind of innovation across the landscape of what had been philanthropy, and maybe will be something slightly different. So against that context, we have this promise of impact investing and those other ideas related to that. A big bank, JP Morgan, put out a report you all may know a while ago saying this could be a $1 trillion asset class. In 2011, it was an $8 billion asset class. In 2012, it was a $9 billion asset class. So the growth rate is small. It's still very small. And there's something inhibiting the rise of social capital markets. I don't know what it is, but I would like to use this panel to try and address what is social capital markets, what are they, and how do they get bigger. So to my far left, I've got Bobby Turner, who's the chairman and CEO of Canyon Capital Realty Advisors. And to my left, I've got Russ Ramsey, chairman and CEO of Ramsey Asset Management. To my right, I've got Gene Case, CEO of the Case Foundation. And finally, Ron Cordes, who runs the Cordes Foundation. Each of these individuals has a lot of experience in other areas as well. So what I'd like to do is just start the discussion. What do you see as the most promising parts of kind of social capital markets? What's inhibiting it? And what are your views that you'd like to kind of start with? Why don't we begin with Jean?
Sure. Well, good morning, everyone, and thanks for making this part of your morning. There's lots of competition here at this conference. When we think about impact investing, we recognize that it's definitely early days. One of the true pioneers in the space that some of you may know is a guy by the name of Luther Reagan, who runs the Global Impact Investing Network. And we were talking recently about where is impact investing, and he was giving a talk, and he said, I'm often asked to use a baseball analogy. Are we in the first inning? Is it the second inning? And he said, and the truth is, it's spring training. And I think that's kind of a good way to look at it. It is truly early days. And as Alex started out, he said, even the title of this panel, he's not sure what it means. We do have a challenge as we really try to turbocharge impact investing and take it forward and make it more mainstream in terms of all the piece parts, including the language set, the definitions, because if you're in the audience this morning, you may have one definition of impact investing that's different than the three people next to you or some of us up here on the stage. So as I look at the opportunity as we get started in this whole new space, it's exciting. We need new models. We need new ways to bring capital to change the world and address critical issues of our day. But I think really kind of a three-step process is needed here. One is education and inspiring. There really is a lot of education needed. I continue to learn every day, and I know many of us on the panel who've been engaged in this stuff continue to learn new things every day. But we need to inspire folks to not only get engaged, but learn about it and have some sense of where the on-ramps might be and how they get started. The second piece is building an ecosystem. There is not really a true ecosystem around impact investing. We as investors are fine with that. There aren't clear rating systems necessarily. Some of the measurements aren't there, the definitions we talked about, the intermediaries, but that's okay. If you look back at venture capital, it was the Wild West when it got started too. Many of those piece parts were missing. So I think that will come. But if we do the first two things, then I do believe we'll unleash a lot of capital, and the goal of $1 trillion going into this space could be really significant. To put that just in perspective for you guys, the total foundation corpus is about 600 to 700 billion that's deployed against social issues today. So clearly, if we could move even some of that 1 trillion, it could be significant impact against what's working today in capital.
Ron, Jean mentioned venture capital, the early days of venture capital. Isn't venture capital impact investing?
Certainly can be. I think that one of the challenges is that impact investing, anytime you create a new investment category, it begs for a definition, and there isn't necessarily an easy definition. So maybe I'll just pivot to some of the work that we're doing. We got into impact investing. I started a family foundation in 2006 when I sold my business, and I got into it out of frustration, in all honesty, because we weren't the Gates Foundation. We had several less zeros on our balance sheet. The impact that consultants and our staff were coming to us about was all about the 5%. Forget about the 95% over here. Just invest that money, and all of the good you can do is going to come out of this 5% grants budget. And I kept kind of raising my hand as a lifelong investor and owner of investment firms and saying, why can't we do good with the 95%? And to Jean's point, we started in 2007. It was the wild, wild west. It reminded me very much of the early days of investing in the hedge fund industry in the 1980s. There were no rating systems. There were no databases. We had to go out and find these deals individually and vet them ourselves, and it was a cumbersome process. And what I've learned out of that process, we're now at 40% impact. And we define impact as investments that are designed to affect social issues that are important to us. So ours are global poverty, global economic empowerment, but that are designed to deliver a competitive investment return. So investments that can really sit on our balance sheet. One of the biggest dangers of impact investing is that it becomes disguised philanthropy. And you get so caught up in the idea that you can solve a problem that you forget about the fact that you're making an investment off your balance sheet. So, and what we've determined out of this whole thing is that we found there's a supply of investment opportunities, firms like Bobby's and others that are putting out products that make sense as investments and solve issues. There's demand from investors. We've sponsored research that have demonstrated that there's demand, but there's the lack of that infrastructure or ecosystem that connects supply and demand. And in our view, a lot of that comes from traditional connectors, the wealth management firms, the banks, the brokerages, the folks that people, whether they're individuals, foundations, institutions, go to for investment advice are largely not having these conversations, don't understand the space, and in many cases are stepping people away from it because it's not something that they know well.
I want to build off that and ask Russ, is this idea of impact investing and social capital markets, is that an asset class, or are we kind of heading down the wrong track and thinking about it as an asset class because big institutional investors won't be able to put a lot of money to work if it's an asset class because they got a pie and they say some goes to equity, some goes to bonds, some goes to alternatives, some goes to this asset class? Am I trying to get a return, financial return, social return? Or should we be thinking about it differently?
Well, Alex, since you framed the beginning of the discussion by, the rise of the social capital markets, will it change the world? What does that mean? I've spent some time since the beginning of this trying to think about, what does that really mean to me? And by way of background, I've got almost 30 years in the global capital markets, kind of as an entrepreneur, as a practitioner, seeing changes in the world and how the traditional financial markets have both adjusted and embraced those changes, some cases with success, some cases with less success. And so as I think about it from my perspective, there's no question that the impact of the growth and vibrancy of the social capital markets will really change the world. And at least from my perspective, a couple things are really quite relevant in sort of asking the questions to try and get to the outcome. So as the first question is, today, do we believe a group of social entrepreneurs and enterprises and financial intermediaries and investors can outperform the current allocation of social impact capital, however you want to define it, governments, foundations, other. But it's obviously very nascent on the foundation and philanthropic side, and at least from my wife and I, and from our perspective as sort of cashed out entrepreneurs and philanthropists going back a while, I don't view it as philanthropy. because that to some degree that's sort of zero return capital. It's 100% loss currently measured. But the idea of, will a market develop for really socially inspired groups to step into the void, either because governments can't do it any longer, because the world is changing, because our youth of America really care about all of these social impact and social issues, or as Bobby will tell us a bit later about just, bottom up finding a need and filling it. I don't think there's any question there is. But I think there's 4 or 5 questions that are just really important, which is why? Why now? Can we have a measurable set of outcomes that will allow us to decide whether it's successful or not? And then finally, are there models, both historical or current, that will start to emerge so that all of a sudden on the world stage, everyone will focus on it? And in this conference, I think there's been a lot of discussion about how very large pools of capital. I heard someone talk about the Ontario Fund in Canada, thinking about on a global risk basis, what is the risk if they don't have a social impact part of their risk equation? And so I think it's actually very relevant because to some degree, all of those questions will emerge. So I believe whether it's an asset class that has its own set of risk-adjusted returns, or it simply steps in the void for enterprise to go, I think the apparatus and the framework will emerge.
Okay, when? What's keeping it from emerging? Bobby, do you have a view as to where step change comes from?
Well, I've got a lot of views, of course.
Let's hear.
And I approach this from both that of a struggling philanthropist and a struggling capitalist, because as a philanthropist, I struggle to make meaningful change. And as a capitalist, I struggle to make change meaningful. And when I look at the challenges in this space, first and foremost, I absolutely hate the term social impact because it implies a sacrifice in yield to the traditional capitalist. I think that 2 tenets are of importance here. Number one is if we want to treat some of societal's problems, if we want to educate 650 kids in East LA, then philanthropy and government spending are just fine. The challenge with government and philanthropy are neither particularly scalable. They're not held accountable necessarily. Oftentimes they're incredibly inefficient at delivering services. If one truly wants to cure today's societal problems, we have to come up with sustainable solutions. And what that means is recognizing that making money and making positive societal change need not be mutually exclusive. That, to me, is social impact, in recognizing the interdependency between profit and purpose. The challenge is the education of institutional investors, because the reality is institutional investors look at social impact and say, my goodness, that comes at a cost, at a yield. The reality is social impact investing can actually deliver better risk-adjusted returns than traditional investments because of the following. We're not trying to create demand. What we're doing is we're finding marketplaces where there's a gross inefficiency of a service being delivered because it's either philanthropy and it's the government, and we pull together the necessary resources to quantify, capture, identify that risk in a for-profit solution. But it's a sustainable solution because if we can make money for our investors, we can raise more money. If we can raise more money, we can build more schools. If we can build more schools, we can dramatically impact the incredible dropout rate and failure that we have as a public education system in America. So I believe that the biggest challenge is educating both philanthropists as well as for-profit capital that this is not charity. It's not philanthropy. It's actually really smart investing. And when Andre Agassi and I went out to raise the Canyon Agassi Fund that builds charter schools a number of years ago, we came across 4 different kinds of potential investors. We came across the unionists who looked at us and said, in no circumstances will we ever invest in a charter school fund because the charter schools are the nemesis of the public school system. So my theory is we're actually very pro-union. It's actually the children's union, however, that we're supporting, as opposed to the teachers' union. We had the capitalist who looked at our model and said, your model is sustainable, but you're selling the schools facilities back to the operators at an off-market price, and you're leaving money on the table. And we would say, but yes, but at the same time, if we left money on the table, that would align interest and we'd have a built-in exit strategy. That's called smart investing. It was the communists that really surprised us. Mike Milken introduced us to CIC, the government of China, and at the end of our presentation, one of the gentlemen from CIC leaned in and said, Mr. Agassi, Mr. Turner, I love this fund. It's brilliant. We'll take the entire $250 million. Now, Andre, if you've met Andre before, he's an incredibly authentic human being. He called me a number of weeks ago on a Sunday morning and said, I need help with math. I'm like, what's the matter? He goes, this multiplication I don't understand. Well, don't you understand? He goes, -3 times -3. I go, yeah. He goes, how's that a +9? How could 3 bad things times 3 bad things be a positive thing in life? I said, I don't know, just memorize it, Andre. He goes, I can't live my life that way. So that when the government of China said they'd take the whole $250 million, I'm about to high-five Andre, and he leans into the table. And he looks at the gentleman from CIC and says, please explain to me. First of all, I'm flattered, but why does the government of China want to invest in a private equity fund focused on education in America? The gentleman from China said, Mr. Agassi, your country is indebted to my country to the tune of $2 trillion. None of us here today will be alive to see that debt repaid. Therefore, we, the government of China, have got to rely upon your next generation of Americans to grow your economy out of the deficit you owe us, and you're failing to educate them.
Good answer.
Now, but that is perspective, because if you ask the audience today, where's the Dow Jones Industrial Average, everyone will raise their hands, and they'll say they know where it is. Where's Facebook trading? Sure, we know. How many kids dropped out of high school last year? No one has a clue. But which is a better barometer on the future health of our society? And why are we not thinking like long-term investors?
All right, with those great opening comments, I'd like actually to move the discussion now to some kind of concrete examples that each of you are excited by in the areas you focus on and the challenges you're struggling with right now as to how do you scale it, is it sustainable?
Sure.
Start, Jen?
Sure. Well, I should say, you know, our own involvement as we step into this space, we're really comfortable in a catalytic mode, whether as philanthropists or investors. And so that obviously informs our approaches and whatnot. And the catalytic idea is maybe before there's proof, maybe before there's measurement, being willing to invest in things that become the proof or the measurement, fully understanding that risk profile and knowing that, you know, a lot of times you don't have winners in that scenario, but you don't need a lot of winners, you just need a few really great winners. And we think that's how movements happen. And, you know, as I sit here this morning and listening to these really informed perspectives that have been brought forward, I think we could all be really smart, really, you know, experienced and bring a lot of background to it. But it might be a space, talking about China's interest, for instance, in investing in this, we're in a disrupted world, right? We've got players at the table that haven't been at the table before, playing a significant role, and we've got a millennial generation that just thinks differently than we do in this room in most cases. You know, they just want to change the world, and when they think about their investments in the future, they don't just think about the money they're going to make. They want to make sure that there is something else that happens that's good because of those investments. So in terms of our own role, we became intrigued with impact investing. We looked around at the leadership that had been in the space for quite some time. We've made impact investments in many companies. We hang with a lot of entrepreneurs all the time. And we asked the question, is there maybe a big idea here? And might this be the time where a large initiative could come together that would be a collaborative of a lot of passionate people around impact investing? And if so, what does that look like? And what are some of the preconditions that might need to be put in place? So we've spent really the last year out talking to partners and leaders, many of them at the table long before we got there with a lot more experience and even dollars and years at work. And you know, it's interesting because we're still asking the questions. We've probably had somewhere close to 300 to 400 conversations with leaders around the nation from different sectors. And I do believe there is sort of this moment, and I don't know if some of you saw it, we brought Sonal Shah in to lead some of the early work. Sonal had come from Google and from Goldman Sachs and then was director of social innovation at the White House. So she took the early pieces of the work to help us figure this out. And then just this week, we brought on Sean Green as entrepreneur in residence at the Case Foundation, and he was chief of innovation at the SBA. So we've got two really great folks. And by the way, I should say new generation folks who are out there really getting a sense of the market more broadly and where things might go.
Ron, I'm going to shift to you, but I want, you built a wealth management firm. Now you co-chair a very large wealth management firm. How do you think about kind of mobilizing the $100 trillion that exists in the investment management industry along any of these lines?
Yeah, so what happened with us is we started investing in 2007 and 2008. We actually went through the storm in 2008 and recognized that the impact investments in our portfolio outperformed everything else in there. And we began to recognize as a little demonstration project in our portfolio that this was working. We could demonstrate impact we were having, we could demonstrate financial returns. So my first question was, gosh, is there real demand for this? Are we the only ones thinking this? Or is there a way through the business that I'd built, working with thousands of financial advisors, to catalyze demand? So as I'd mentioned earlier, we in our foundation, we actually funded an initiative with the Calvert and Rockefeller Foundations called Impact Assets, a nonprofit financial services company. I was at a hedge fund conference last week, and I had to stop there and repeat that very slowly for the group. But we're a nonprofit financial services company, and our goal is to catalyze capital into the space through the financial advisory intermediaries. And we started by trying to prove that there was demand. We did a survey of 1,100 high net worth investors, and we asked them a series of questions around if you were presented with an opportunity in your portfolio to do good and do well, a competitive financial return, and to meet a social or environmental metric that was important to you, would you be interested? And the results were actually stunningly positive to us. 48% said they'd be very interested. 40% said they'd be somewhat interested, and only 12% said no thanks, not for me. So almost 90% were interested at some level. Then we asked the key second question, how many of you are doing it today? And the answer that the surveyors came back with was pretty much as statistically close to zero as you could get. So virtually nobody was doing it, and the reasons all had to do with this interconnectedness, this ecosystem, the way in which they invested, whether it be through a Merrill Lynch, a major bank, an independent financial advisor, a family office. What I really found was that the gatekeepers of this capital were keeping the gates closed. So my passion now is to go to that community and not only demonstrate to them that there's a real opportunity here and that there's demand and there's products available. So it's not demand, it's not supply, it's the ecosystem, but also to demonstrate that it's in their enlightened self-interest to be in front of this, to get in front of this wave, that there's a real opportunity here from a client relationship perspective to be answering a question that a client wants to ask and to be engaging clients and next gens in conversations that clients want to have. So we provide research, we provide surveys and studies, we provide the first database available of the top 50 managers in the space because there are no publicly available, or there were no previously, publicly available databases. If I was a wealth manager, wanted to do an RFP on microfinance funds, I'd have to go out and try to cobble that universe together on my own. So we've tried to make it easier for the wealth management community to take a first step forward, and we're finding that it's slow, but we're getting traction.
That's a key point, which is, there are a lot of different ways you can come at the same challenge that we're talking about, and that's fine. So this ambiguity in terms of the definitions is okay. Just like in investing, there's a lot of different ways you can invest, by asset class, by region, by risk, et cetera. And that works. People come at it from a lot of different directions. But you mentioned something, Ron, about kind of the gatekeepers and how you get that flywheel going. And I just want to make a comment, and I want to ask Bobby to take it on, which is that my prior role, I worked at a big foundation, the Gates Foundation. There we had a living donor. I could go to him and say, hey, use some of your endowment and make investments. He was an enlightened guy. He said, okay, I'll take the chance. You go to more traditional foundations where the living donor isn't living anymore, or the donor's not living anymore, and a lot of the board members maybe aren't willing to take that risk. There's a Chinese wall between often the giving the program side and the investment side. And then that's one challenge. Then you go to the big investment pools of capital, the kind that are your LPs, whether they're sovereign wealth funds or banks or whatever. And they struggle to know where to put something that's ambiguous in terms of its definition in their pie chart. So how do you get at that kind of chicken and egg problem?
First of all, it's a battlefield out there. I have pulled out a strand of hair from the top of my head for every no I've received over the last 15 years. In 1998, when Magic Johnson and I went out to raise the first Canyon Johnson Urban Fund, I bet him it would take us 6 months to raise the fund. The fundamentals were incredibly compelling. Who's not going to want to invest in the fastest growing subset of America? The mismatches were huge and easily identifiable. My firm, we had tens of billions of dollars under management. Our track record was great. Who wouldn't want to invest with Magic Johnson? And remember Magic looking down upon me. He has to anatomically, of course. and said to me, boy, I thought I was getting a smart partner. I go, what do you mean? He goes, this is going to take us 2 years to raise. I said, why would you think that? He goes, well, because institutional capital looks like you, Bobby, and it doesn't look like me. And you're not ready to understand the risks or the opportunity of investing in emerging markets. It will take us 2 years. So I bet him. Had you bet on both of us, you would have been right, because it took us 2 years and 6 months to raise the first fund. Not so funny. I mean, it really happened that way. But you can't take no for an answer. So we're chipping away. Our second fund took us 2.5 months. 4 years later, once we had a track record, and it was $600 million. Our third fund was $1 billion. But when Andre Agassi and I got out there, again, pioneering in the space of education, I thought it would take us 2.5 years. It only took us a year, but what we had to find is we had to find the realists. We had talked about the unionists, the capitalists, the communists. There are realists out there. And the realists are those that recognize the following and ask the question, what are the consequences of you not investing in a fund like Canyon Agassi? And if they answer it's unconscionable, then they became investors. But truth be told, I played tennis with your former boss, Bill Gates. It was me and Andre against Steffi and Bill. And needless to say, Bill won, as he always does. Bill would not invest in our fund. In my predecessor life as a philanthropist, Bill had given me tens and tens of millions of dollars to build charter schools in Los Angeles as a not-for-profit. We said, okay, Bill, we're going to scale it now. We'd like you to invest in a for-profit. Do not want to confuse my philanthropy with my for-profit initiatives. We said, but Bill, we need your good housekeeping seal of approval to say that it is absolutely okay to make money and make societal change. But we couldn't get Bill to do it. We couldn't get Michael Bloomberg to do it. We couldn't get lots of people to do it because they didn't want to confuse mission versus profits. So that is a challenge.
So on that point, Al Gore, David Blood, they set up Generation Investment Management a while ago now. Returns have been decent, as I understand it. A long equity fund, basically, mutual funds, right? And they've chosen to address it by basically saying you can set up a traditional for-profit investment firm that has another dimension in terms of social impact and is less correlated. Is that a scalable approach? I want to ask you, Russ, because you know the asset management industry pretty well. You sold your business. As you look at kind of the next thing you're going to do, how do you contextualize that?
Well, I'm struck by a couple things about the discussion of this evolution of social impact markets and what's going to happen, and it's sort of the classic sort of top down and sort of bottom up. And I think what we're hearing here is a lot of really compelling bottom up examples of there's no question that there is real value added and both an economic and social return from having this activity continue to grow and flourish. The question is sort of time frame and allocation of capital, and is it enough, and when does it really have an impact? And if you look at the history of markets, you never know when there's an inflection point where sort of everything comes together. I mean, I'll use the example of the internet. The internet was around for 30 years. It was there, everybody, it existed, et cetera, and it wasn't until the IPO of Netscape in '94 and AOL bringing it to the consumer, and all of a sudden, boom, you had that along with something people don't talk about much, but the Telecom Dereg Act of '96, and all of a sudden you had this very controversial, lots and lots of skeptics. How's it ever going to happen? It's just a bunch of hocus pocus. There's nothing real. Nobody's saying that anymore today. So I don't know what the inflection points are that bring sort of this idea that this is a real serious allocation of capital for real social and economic good, both replacing current providers as well as being additive because it has smart investment components to it. But I would just suggest that as soon as there can be more of a framework, there can be more of a set of standards, much like, I can remember I'm an alum of George Washington University, and, we're an urban campus in the city, and we had a new president came in and said, in the mid-2000s, we need a sustainability initiative. I go, what the hell is that? Sustainability? I've never even heard of it. What's it mean? And 7 years later, if you don't have a sustainability office, you don't have a sustainability issue, you aren't rarely focused on everything you're doing relative to your infrastructure and lead certifying everything you do, you're out of business. Well, that's in 4 or 5 short years. So I don't know the exact analogy. I just know that it's happening, and in my judgment, you have the kindling that's going to light the fire, and I think it's here to stay.
So, Gene, you mentioned you were thinking about a large-scale approach to this. You obviously know something about the internet that we just mentioned. What's
a bit
going
or two. Yeah.
what you do, yes. What's going to be a tipping point for you to decide, okay, we're all in, we're going big, or we're not? How do you look at that framework?
Well, I'm not sure there's going to be one thing that's going to change us, but what I will say is going back to the new dynamics and even picking up on Russ's idea of the tipping point, we're really drawn to things that democratize movements. And so we've been talking about the institutional role here, which I think is really exciting. And if we're talking in numbers like $1 trillion, we got to be talking institutional. But the gatekeepers that were mentioned before are very real. And they generally represent a generation that thinks differently. So we have crowdfunding that's going to be coming along. And there's been a lot of talk about crowdfunding. There was a panel yesterday talking about it. We did a thing last night. Some of you might have been there. And generally, we're really jazzed at the idea of crowdfunding. And are there risks in crowdfunding? There are. Many of us are trying to put things in place to limit those risks as new investors come in and play a role. But I really don't know if we'll sit in rooms and draw out how this is going to evolve. I mean, this is what I was trying to say before. I think there could be tipping points and movements, and then it takes off. AOL was a 10-year overnight success. And a lot of people forget that 10 years of pick and shovel, right? So there's been a lot of pick and shovel going on in impact investing. I'd like to believe when we can mobilize and educate and inspire millions and millions, that's going to look like a tipping point to me. And I don't know if they'll lead, and then institutions will get a little more interested, or what's going to basically be the tipping point. But we're really, really excited about crowdfunding coming and more of a democratization of the idea. It always struck us as really bizarre that in the United States, you can go to Las Vegas and lose $5,000, and that's legal, but you couldn't take $5,000 as an investor and invest it in a company without all kinds of regulations coming down on you. So, we're excited about the opportunity for everybody to play roles as investors, just as wealthy, privileged people have been able to do for a long time.
One of the great things we have on our side is time, because the gatekeepers, the old guard, within overnight success, within 20 years they'll be gone. And the reality is, and we don't want to wait 20 years, but if we've got to wait 20 years,
including all of us in that discussion.
Absolutely.
Because the reality is, Gene, you were talking about statistics. We do a lot of research on Gen Ys and Gen Zs, and there's a couple stats that I'd love to read off. In the research we did, 64% of Gen Ys and Gen Zs rank making the world a better place as a priority in life. 84% believe that corporations are more likely than politicians to change the world. 67% believe they could make more of a difference in the world by running their own business than they could by running for political office. Only 27% feel that making money can buy happiness. With that sort of paradigm of change, of values, when they become the leaders of corporate America, when they become the CIOs, the CEOs, the CFOs, they'll make different decisions with regards to how they allocate capital.
I want to
just back to kind of the inflection points, and we don't, none of us really know, but when I think about just the title of this panel, back to your original question, social capital markets, will they change the world? Well, it's sort of ironic that perhaps it sits over here, and we have something which really wasn't talked about at all 3 years ago, social media, which has changed the world and is changing it every single day. And so this sort of juxtaposition of the two together and the enabling technology, it's the chicken and the egg, but I just would suggest that with all this talk about foundations and others, it may actually be the social media and exactly what Bobby's talking about, that kind of forces a lot of this change of thinking, and it could happen much faster than any of us realize.
You can't afford to fail, though, because when we raised our first urban fund, had we not been profitable, we would have set back the initiative decades.
That's a point I want to pick up on for a second, which is I think we can actually make this pretty simple. Maybe you'll disagree with this, but I think it looks something like this. There are a lot of different ways that you'll be able to invest or can invest today, and you can make an argument that a vast number of them have a social impact. You can choose to emphasize a social impact or not. Some of that is optics, some of that is what you want to spend your time kind of underscoring to your investors. Sometimes you can design a fund around the social impact, assuming you'll also get a financial return. But at the end of the day, there has to be a financial return. And as a capital allocator, I can tell you that the way this grows, for my pool of capital at least, is I'll put more money to work when I see returns, and that'll take time. But that's it. I'll make investments, I'll see returns, I'll make more investments. Ron, challenge that.
I won't challenge that. No, I agree completely. That, and I also agree with Gene's analogy of a 10-year overnight success. I think a lot of us that have been in this space for a while are frustrated by the fact that it's not moving more quickly. But I step back and I say, we are moving forward, and we're bringing new players in. And I think events like this that maybe bring people in a room that hadn't yet focused in their own portfolios or on what this is and are looking to learn more. And I think to Bobby's point, I see so much positive activity in the millennials, the next gens. I see it on college campuses where impact investing classes are among the most popular now, places like Columbia and HBS and Duke.
Right.
And I go in and I speak to these students, and there's 100 of them in the room, and they all come up to me afterwards, and they all want to come work for Impact Assets. And I say, we're a nonprofit. We have 9 FTEs right now. And it's frustrating for them that they want to get involved in this space. And what I tell them is, go to work with a traditional firm. Go to a Goldman. Go to a Credit Suisse. Go to a JP Morgan. Learn the business, but learn it with a lens of where it is you'd like to ultimately go, and become an entrepreneur in those firms. 2 weeks ago, I was called into a major bank in New York. There's a group of under 30s in the bank that have a monthly symposium where they bring people in. And this month it was on impact, and it's all values-based. This month it was on impact investing. And so I expected to have a room of about 50 people, all of which were my kids' age. Well, there were a lot of young people there, but they managed to bring in the head of the private bank, the head of asset management, one of the heads of investment banking. And it's because all of these folks who were my age were interested in what this buzz was about. And out of that, I think there's some good things that will end up happening.
Yeah, Bobby, I've loved everything you've said. I do want to just maybe pause on your comment about we can't have failure. Because, and we were at a panel yesterday morning, and I spoke about a campaign/initiative that the Case Foundation launched last year under the mantra of be fearless. And the purpose for it was to look at work that had been transformational in philanthropy and in social missions. And what was behind that, what principles existed there. And it came out that there were a few common principles in most of the breakthrough things we had seen. And I think most of us would agree, in philanthropy, there aren't a lot of regular breakthrough things. Most things we try don't, in the long run, have a lot of impact that can be measured. But it started, one of the first principles is a big idea, don't accept incremental change. And I would say we're all talking about a big idea. We understand it's going to be incremental steps to get there, and then there's going to be an inflection point. But we're onto a big idea. But the second two pieces are experiment, try new things, and accept that failure might be an outcome. Does that mean we want failure? No. Does that mean we like failure? No. But it means to find innovation, you have to put failure at risk. And while we're trying to build, I would be very sad if we said failure is just unacceptable. Of course, we all want to say that, but that's not how things move forward. There's just no basis or background around that. And I completely agree with your point that we're so early that the failures could undo us, right? But think about the venture capital markets today. 60% of venture investments actually don't work out. They rely on a few big winners that sort of carry the stream. And so while I hope we don't have failures, I hope we try new things towards innovation, and we may fail along the way, but hopefully out of that same experimentation, others will learn and move forward faster because of it. They'll fail fast. And maybe some really bright spot takeoff kind of things will happen that will really create a big stream.
This is where you come in, because a CIO of a major pension fund, fearless is not a word on his resume.
Completely agree. And that's why I
fearful.
question if the institutes are going to lead, because I think, high net worth individuals, living donors, as we talked about, people who maybe are comfortable with a little more risk, or groups that are more comfortable with a little risk, might be willing to take those early arrows, have some of the failures to prove it out, and then maybe
Right.
maybe this is
So
the
that
one.
is our job, is to educate those that can afford to be fearless right now.
Agree
Because you've got
entirely.
to allow-
Educate and inspire.
You've got to allow the platform.
But the only way to educate
grow.
them is by actually doing deals, doing investments.
Of course.
Yeah.
Well, and if I could just, perhaps comment on your other question about, is this an asset class and will it emerge?
Thank you.
I think that, what we're hearing today in the discussion is, as a prediction, there isn't any question it will emerge as an asset class with the types of descriptions that exist in current asset allocation models today. There will be angel and Series A rounds for social impact solution companies, very early stage startup in the halls of universities and little companies. There will be growth capital, there will be asset base for agriculture and water development and everything else that go with hard assets, much like what you have done is been able to build hard assets for a solution, generate a return, and there's a risk reward that assumes a return to capital plus a return versus 100% risk.
Right.
And so from my perspective, it will emerge. And again, I go back to the mid 90s where, in the series of 3 or 4 years, the market cap of internet companies went from roughly 0 to several trillion. And obviously a lot of that went away, but that's the markets, that's risk and reward. And you have to have a time frame that matches the two together. And I don't think anybody argues that or would argue today that there hasn't been systemic change as a result of that dynamic.
I do want to have a dialogue with folks in the room because I know there are a lot of people here who have experience, views that will add a lot to the debate. Do we have a microphone, or I wonder if there's someone here who can? Yeah, there we go. Does anyone want to jump into this? Yeah, here we go, right here. One sec,
Got a
just wait
mic.
for the mic.
Hold on, just 1 second.
It's recorded, though.
Thank you. So drawing on a couple of themes of democratizing philanthropy and impact investing, as well as getting younger people involved, who's going to be creating the consumer-facing retail impact investing products for people of my generation?
Maybe I'll take that because that's a challenge today. So to begin with, when Alex talks about $8, $9, $10 billion, all of that is in private investments, private debt and equity investments. These markets are still small, and here in the U.S., until the recent advent of crowdfunding, private debt and equity investments, if you're a product developer, you're building products for investors with 5 million or more of assets available to invest. It's just the way the rules work in building these types of products. So that limits you from 99.99% of the population. And I hear it on university campuses, it completely limits from the young people that might have an investment in a 401k, and they're really interested in saying, I'd like to take a piece of that and put it towards something that's important to me. So I think what it's going to take to build, it's a few things. It's relaxing some of the regulations. We're building some products that impact assets, which we're able to do as a nonprofit that get around some of the regulations, and we think we can come out in a 25, 50, 100,000 arena. But the real democratization will come when there's enough liquidity in the space that we can actually build mutual fund products, exchange-traded fund, ETF products, where those products can then become part of a mutual fund you could go buy at Schwab, or one of the 30 options in your 401k is an option to invest in something like microfinance.
Right. The
demand is clearly there. I think that I will predict that the first of those categories that may become available is microfinance debt. It's a $46 billion industry today. That debt is now beginning to become securitized at a lot of major firms. And as that market opens up, I'm talking to people today that are thinking about, okay, how could we create an exchange-traded fund for microfinance debt, make it available with a $500 or $1,000 minimum investment, and open us up to the demand that we know is there?
I see a guy in the room who I want to call on. He's going to kill me for doing it. But Mark, you oversee over 100 billion in discretionary assets. You heard this debate. What would compel you to start moving assets into what we're calling impact investing? How do you think about it?
Thank you, Alex. It is early morning. What I would say on that, as you pointed out and as other panelists pointed out, our investors are focused on returns first. And maybe with the help of panels like this and some of the efforts, we can get them to be focused on some of the other things that they take into account in their daily life, but take off that pure investment focus hat for a little while and focus on the other things. And I was very surprised to hear about those comments about Bill Gates being so rigid in separating these topics. And maybe you can speak to him when you see him later today.
But Mark, you're saying you need investment returns first and foremost. If you don't have that, everything else, no matter how good it sounds, doesn't matter.
Yes, that's what I'm saying.
And that's your class today. To answer the first question, Kickstarter, in a lot of ways, as a platform, a crowdfunding platform, I think might point to the potential here, because in the Kickstarter example, you're just giving money to things that you care about. It's not philanthropic necessarily, and it's not for a return. And it's amazing to me in the new generation how many people are willing to write checks basically just because they really believe that something good is going to happen. And we've seen people just bring basic projects and avoid either starting companies or starting nonprofits and get funded through those kind of channels. We work closely with a lot of the private wealth management offices in the big banks, and I sort of feel like I haven't been kind to institutions this morning. I don't mean to come across that way, but I will say if you talk to them, they will tell you many of their clients are asking for these on-ramps, for these various vehicles to begin to utilize some of their investment, and willing to give up a little bit of return, and in some cases a lot of return. Mike Milken was with us. We did an impact investing session with Omidyar a few months ago and had a bunch of great folks in the room who had a lot of experience, and some who just were totally new to the game. And Mike made the point, and I'll bring it up because it's his conference, Mike made the point that, heck, in some cases, in some classes you've got a 1% return today, and then you have market rate returns. In philanthropy, as we said, it's 100% loss of capital. So you really have a pretty wide band that you could potentially play in and hopefully communicate and educate investors to say, if you care about changing the world, are you comfortable at a different place maybe before you get to market rate returns to have that kind of
That's a key, because if you look at government bonds today, U.S. government, long-term bonds, you're not even going to get your money back after inflation.
Right, 0%.
But people put it in their portfolios, right? Because from a risk perspective, they say, institutional investors, well, I need to balance out other asset classes. So thinking about this on a risk spectrum may be important. Yeah. Okay, then we'll move it here.
If you look in your global conference book, you'll see at 7 o'clock there was Impact Investing in Israel Roundtable. And it's exactly what you guys are talking about. And the most interesting thing there was what Sir Ronald Cohn did in England in October 2010. He created a for-profit group where they first targeted youth that comes out of jail under the age of 21, and they did a for-profit deal with the government where they calculated 65% of all the guys released from prison went back to jail. So they did a deal with the government that they would take people that came out of England's prisons, they would rehabilitate them, educate them, and the percent that of the money saved based on the 65%, they would divide 50-50. The government would get half the profit and the investors would get half the profit. And so Sir Ronald reported that, this is from Mark Rowan, that the investors actually kept the investments on this, 16 out of 19 kept them on their balance sheets as investments and not as grants. And one of the gentlemen there was working now for Sir Ronald in Israel now, doing the same thing in Israel. And in fact, last year on Thursday, right after the conference, we had a one-day conference discussing how to do this in Israel. And following the model of AOL and Steve Case, when something works, rather than invent it new, it's really a smart idea to see how it's worked and build on it. So if anybody's interested, they can see me or talk to the people that were on that 7 o'clock to 8:15 panel this morning.
Thank you. Any comments on social impact bonds? Or
Well, I think that many of our social issues will not be solved by sustainable solutions because you can't drive profits. By way of example, there's not going to be, if you want to add music back into school programs, I can't make money off of that. So therefore, I can't raise money for it. Notwithstanding is, when you look at social impact, one wants to create wealth. One also wants to reduce expenses or burden on society. And I think there is a significant groundswell and thought process towards how do we compensate philanthropies for being innovative. Because for a philanthropy to be successful, sustainable, and scalable, they're going to have to think of innovative ways to finance their growth and their missions. And we're working, I think people are now beginning to work with the government and with communities to say, hey, if we keep kids out of jail, we spend 3 times as much to incarcerate than we do to educate. So therefore, if you have a social impact program that keeps kids out of jail, you should be compensated for that because your mission, your impact is quantifiable. It may not be quantifiable in revenues, but it could be quantifiable in a reduction in expenses. And I think that market is beginning to establish itself as well.
I just want to note that the social impact bonds, we talked a little bit about them this morning in our panel prep, started in the UK, and the first social impact bond was actually floated and financed by a combination of Bloomberg Philanthropy and Goldman Sachs
yeah.
here in the US. And I can tell you that's the world that I live in. Goldman put up a very modest amount of their proprietary capital toward this, but what it did is it got the notice of all of the other major banks who are now looking at what do we do there, and if Goldman put up X, how could we put up 2X? And that's the type of, that's just kind of the way this world works, and I think it's not for everything because you've got definable issues that you can really measure that work best for it. But I think it's a really interesting solution, and it's one that the major banks are starting to take notice of.
Yeah, in the front. Can we bring the mic over here? Sure. Thanks, then we'll go there.
I'm sorry, just building on that point, I'm finding that the line in the financial services companies that have foundations also is becoming extremely blurry. And where the investments are being made in impact areas, the philanthropic arms are starting to look at making the investment side, not just the grant side. And IRS issues could come into play in here as well. What should be that role between the philanthropic side or the foundation versus the actual core business of the banks?
Great question. I think we haven't maybe spent enough time talking about other things that are available. We talked about impact investing having different definitions as we sat down. But I think about it as, and I think many organizations do too, trying to put all the oars in the water. I mean, Ron talked about, most foundations and philanthropies have a corpus and they're going to spend 5% of that. And of that 5%, there are actually lots of innovative things they can do along these impact investing lines. The program-related investments is one way where basically you can make investments. They need to be a little below market rates, but it's a way to use grant dollars to make investments. We've done a lot on the debt side with loan guarantees and different vehicles like that. But I think what we're going to see, I hope, is more of a blended world where you're really trying to impact something. You're really on a mission. And as Ron sort of said, I think in the opening remarks, why would you just use 5% of what you have to do that? There's so many other vehicles you can put into play. And I love the blurriness that we're seeing in this space between what's philanthropy, what's investment, and in some cases in the corporate structure, what's products and services and what's coming out of the foundation side.
I think right behind you, we also have, yeah.
Hi, Shari Berenbach, now at the Africa Development Foundation. I'd actually like to pick up on exactly this theme in recognizing for so many institutional investors and their financial advisors and wealth managers, they're really judged by the kind of financial return that they're able to achieve. And so I think that for many of these institutional investors, it's very almost threatening, this notion that they're also going to be asked to be considering these social objectives, which they consider to be sort of outside of their realm. And so the question becomes, how do we begin to, help people recognize that it doesn't have to feel as scary as it immediately appears. I mean, we do know of institutional investors, let's say in Canada and elsewhere, who are always thinking about the longer term goals and recognize that there could well be a social dimension in the long-term goals as well as a financial dimension. I mean, and it's an educational process. It's looking at where it's happening elsewhere in the world. And I'm just wondering if we could be thinking about how do we begin to shift the perspective that somehow involving social considerations takes you onto a risky, slippery slope that people are very concerned about going to. But I do, before I stop, I do want to just mention for retail individual investors, there is something online called Microplace, where there's a range of different investment products that are available for as little as $20. So that is an answer that's available today.
Sorry, can you pass that to Eva in front of you, who right actually in front, who I think you're kind of in the venture capital business, but you're also in the business of generating social returns. So how do you answer that question?
Well, I think it's kind of a big question. I was actually thinking when you were speaking that it's not so easy to quantify the social aspect and how exactly from getting to know some of the large institutions, how exactly they can do that. For us, because we're doing VC, it's very company specific. So what we do is we actually break down the business model into individual components, and we align that with our mission, which is livelihood improvement among the bottom of the economic pyramid. That said, how do you actually aggregate that up? I think to perhaps point to a taxonomy that some people already might know in the room, which is IRIS, the Impact Reporting and Investment Standards. We kind of try to define each, perhaps would call it a vertical within the company, along that taxonomy. And perhaps that's a way that larger institutions, and I think this is not a question that we've answered because we are very, very small in our focus. So perhaps that's an additional way to kind of aggregate things up. But I would look to the panel to provide more insight.
Anyone want to
Well,
provide
I mean,
insight?
it depends. In infrastructure, it's very easy to quantify the social impact. If you're building school seats, you can see how well the children perform in standardized testing. If you're building affordable workforce housing, you can see how many kids you're putting into a safe, nurturing environment at night. If you're generating and building community-serving retail, again, it's job creation, it's incremental tax revenues, and sales taxes and wage taxes that can then be reinvested in the form of social services.
So is transportation net positive that way too?
Transportation opens up a real Pandora's box with regards to issues because, of course, one of the primary causes of CO2 emissions in this country are based upon the inefficiency in how we live. As Americans, our average square footage in home is about 2,500 square feet versus in South Korea, it's about 800 square feet.
But I ask you that intentionally, which is, this is a very subjective set of definitions as to what's beneficial, what's not. I'm not sure it's always black and white.
It's absolutely not. And it's very difficult to quantify the impact on the environment. What's the dollar value? How many metric tons of CO2 have you extracted from the atmosphere?
Yeah. Can we move the mic over here? Who's ever got
So
it?
Alex, I just want to follow, Russ brought up sustainability and that movement and how it sort of took off. My husband, we debate this impact investing thing and just exactly along the questions that were just asked in terms of trying to bring understanding to investors of what they're investing in. And IRIS is great. It's a set of indices, probably maybe too many, but there's a lot of indices against which you can measure the company's performance on a number of different fronts. But my husband's had this idea, which I think is really great. We were talking about it at dinner last night. If you look at sustainability, it really was the LEED certification, this idea, right, that you had like a platinum level and different levels, and you knew what that meant. Because if it was under these sort of different labels, that sort of told you something. We're missing that in this space, and I think a lot of us feel like that might be a really good step to get to, which would consolidate a lot of those very complicated IRIS indices, which still should exist for many particular institutional investments, but particularly at the retail or consumer level, trying to provide a way that there are these sort of segments that you can understand based on like a LEEDs kind of position.
And if I could just perhaps add on to that, there's been a lot of discussion on a number of different sort of capital allocation levels, but I would not rule out the possibility that the biggest market of all is the public markets. It's the public equity markets. And there's obviously this sort of challenge between wealth creation and enterprises and grant making and philanthropy, but what if, companies start to have a social responsibility quotient? And what if, some combination of Washington or the SEC, starts to really, require that there be disclosures about a social responsibility quotient? And what if, instead of the Community Reinvestment Act, which banks did everything possible, in my opinion, to try to meet the requirement, but were never vested in it because it didn't feel like it had it felt like it was risky, and it didn't really feel like it had measurable impact, and it did not impact their market values. But what if we start to get that, and the market starts to differentiate And multiples are differentiated because of how companies are viewed on a global basis relative to this idea. So my point to that is we don't know. And if that happens, I can guarantee you that the corporate allocation of capital, the R&D budgets associated with social responsibility and social impact, and the global call to action for the big, bad, wealthy corporations to step into the void of what's not happening with governments will happen much faster than anybody realizes. I don't know that'll happen, but I just would suggest that it is a real possibility.
A couple statistics from our research that...
You're going to agree or disagree?
I am agreeing.
Okay, good. All right, you can go.
And we'll let him talk.
And in fact, I'll embellish the statistics to support you. 56% of Gen Y and Gen Z would take a pay cut to work somewhere that is positively changing the world.
EPS goes up.
Okay, that's number one. Number two, in the past year, 27% started purchasing or supporting brands that specifically because of their social, responsible practices and ethics. So in a positive way, these consumers are supporting companies that have good corporate responsibility and social impact. And on the opposite side, in the past year, 30% stopped supporting a brand because of something they learned about in its corporate practice or ethics.
Look at the legal profession, where they've had pro bono as an institutionalized part of their work for a while. And if you talk to law school grads, a lot of them will say they looked at which law firm to join based on, was it real, was it supported? You know, there's a virtuous circle. But there was someone in the front who wanted to...
Josh Cohen from City Light Capital. So, since Russ has opened up the what-if question, I'll throw two of my own that I'd love the panel to respond to.
Speak loudly if you could.
Sorry. So,
What happened to the microphone?
Here's the mic right there.
So since Russ opened up the what-if question, I have two of my own that I'd love for the panel to respond to. What would the world look like and what would money management look like if the 2 and 20 wasn't just based on financial returns, that if there were part of the carry you paid to a money manager was based on their ability to hit social metrics? It might have some profound effect on what data you had available if you were incenting to have that data. So we'd love to you to respond about that. The second thing is about risk. There's been a lot of talk around financial returns, and if you show you can make money, then institutions such as this one will show up and follow. The real reason, my perspective as to why there hasn't been as much money has more to do with risk and less returns. It's the operational risk, it's the market risk, it's the unknown of the security. Is it possible that risk in this category is just misunderstood? That people should consider the risk of the status quo and that the risk of non-education reform and what it looks like for this country is too painful and should be priced into consideration when making these types of decisions?
Ron, you're going to weigh in.
I see this a lot, and I think that notwithstanding everything that our industry, the wealth management investment industry has done to try to quantify risk, all the different types of measurements that we've come up with, really what is unfamiliar is inherently risky. So if I've never invested in charter schools in the inner city before, that investment seems much riskier to me than something that I have familiarity with. We've seen it in our own portfolio where we're heavily invested today in small, medium enterprises in Africa. And immediately other investors that I talk to about our portfolio perceive that as being a lot more risky than being invested perhaps more close to home. And I ask them, well, why? Is it because those markets are growing so much more slowly than here in the US? No. Is it, you go through you start to have a logical discussion and people realize that they may have reached that conclusion too quickly. But that's one of the things that I think we're fighting in this space is that many of the types of investments that comprise this impact space, including social impact bonds, which have a great deal of promise, are new, don't necessarily have long track records. And so I think the perceived risk and the actual risk, I know in my portfolio, the perceived risk that other investors see in our portfolio and the actual level of risk that we've experienced are dramatically different. As an example, we've been working with the IFC and OPIC, two of the development finance institutions, between them a 20-year history of investing in developing markets. And they need, and I've told them this, to do a better job of quantifying the risk and returns that they've actually experienced to be able to start to demonstrate that there is a track record for things that are perceived to be unfamiliar.
Ron, you also have to be crafty as to how you identify potential investors. There's obviously a market risk. There's also an enterprise risk. I think one of the big challenges in our space is there aren't a lot of canyons out there that have a social impact platform that also have $20 billion under management. I mean, it's not our primary business. I mean, I'm known as the liberal partner in the firm. It's not the most money-making center. But I think that as you look at the opportunities, there will be challenges in identifying the market leaders in the space. But with regards to the markets themselves, my wife and I were in bed watching NBC News 3 years ago. Brian Williams had his Education Nation, and he was interviewing the chairman of Intel Corporation. And he said on the news, Intel is committed to education. In fact, we're going to invest $1 billion in K-12 education over the next 10 years. At that point, I had an elbow in my chest from my wife saying, hey, dummy, make a call tomorrow. The next morning, I picked up the phone and I called Paul Antonelli, who was the chairman of Intel, and I said, hi, it's Bobby Turner and Andre Agassi. We'd like to speak with the chairman. Andre was the perfect ambassador of Great Will. Intel became a $25 million investor in our Canyon Agassi fund because they are familiar with and comfortable with the risk of education.
Do you have a 2 and 20 type fee structure?
We have a 1.5 and 20 above an 8% preferred return.
Okay, so that 8% is your hurdle rate on the financial side. Do you have a hurdle rate on the social side?
There is not. Well, the answer is yes. We've committed to generate at least 25,000 school seats in 5 years.
And if you don't?
We'll never be able to raise another fund from those investors.
And one other question, because you're on the spot now. There's something you ever seen the barber pole? You know, those old barber shops you go to. They had.
You're asking a bald man.
God, I stepped on that long time. Touche. All right, I'll just shut up now. There's a question in the back there.
Moving right along.
A great discussion. I'm from Grand Challenges Canada. We're funded by the government of Canada, and essentially they've given us the mandate to test new models of how do you take innovations in low middle income countries to scale. And so we have a pipeline of about 300 innovations. I'm at a reflection point right now because I'm starting to do these direct deals where we're getting interest from angel investors, from different foundations to come on to actually take these innovations through. But then I'm also looking at a fund-to-fund type of approach, and we're also involved with another impact investment fund in global health. So I'd just love to get your reflections on, in the global health area, these are innovators, social enterprises in low middle income countries. What's that secret sauce to really start to get investors to come in? Is it deal by deal, build it up, get the momentum, or is it coming out with a big, here's a fund-to-fund type of approach, come on in?
Alex, you should speak to this from your old sort of Gates Foundation role.
Well, actually, I can speak to it. Thanks, Gene. I can speak to it from a more current one, which is the place I'm working. We've spent a long time trying to raise a SME private equity fund of funds focused on the developing world, a set of countries. It's been really hard, and we're going out to. We have $2 trillion, so we know where all the money sits, at least in our universe. We go to these people and we say, "Hey, don't you want to invest in stuff not so dissimilar from what you described?" And it's been so hard, and the reason, as I look back, why it's been so hard is because we really screwed up the marketing of this. So we mixed the apples and oranges cliche. In other words, we went to traditional family offices and we spoke to their CIOs because that's who we usually deal with, and they looked at it and they said, "Is this a for-profit investment? What's the return? How does it fit into my pie?" Then we went to foundations and we said, and philanthropic capital, and we said, "And you can get a financial return." And they said, okay, does this sit in my philanthropic side or my... It sounds simplistic to put it, but we just kind of got it wrong. That's one hindrance I see. I don't know if you guys have a view.
Go ahead, Ron.
So it's interesting. I've been involved. I was a seed investor in a fund of funds in the developing world, and we struggled with raising money from that same perspective. It was almost like we were a tweener, right? We weren't one, we weren't the other. And what we found was that there are a growing number of investors like us, like what Gates did under your leadership, that are putting a portion of their assets into these double bottom line investments. But if you're not talking to one of those, then they're trying to get at it from one of two perspectives. And I think it is a challenge. And it's a challenge really more from the marketing and distribution side of how do you come in and create the right expectations and talk to the right people?
Yeah, so at the foundation, we don't have program officers, we have social innovation chiefs. and they typically have a private sector background and hopefully some familiarity with the investment. There is this world where the investment officers don't understand sort of what program managers do, and program managers often don't have an investment mindset. And I think that's hard, but one of our favorite lines is Mark Andreessen, who, by the way, is not at all sold on impact investing, who said, you know, the problem with impact investing is it's like a houseboat. It's not a really great house, and it's not a really great boat. And we hope that's not the case.
But you can have fun parties on
You
it.
can. You can have a good time on a houseboat. But this tweener world is something we've got to figure out, right? How to bring the right talent, the right backgrounds, the right perspectives if this thing is going to move forward.
We're pretty much out of time. So last comments from anybody, summing up, the one insight you think is most valuable to share? It has to be in 30 seconds or less. Go.
Again, for me, I just think that we need to recognize that making positive societal change and making a fair return on investment don't need to be mutually exclusive. And in fact, there's great synergies between combining purpose and profits.
Right.
You know, I think we're one publication away from this market taking off. It's something like this Investor's Guide to Social Impact Investing, and it's somewhere between 5,000 and 5,000 pages long. But I do believe that we have a framework for the discussion and the debate. And as the combination of wealth creation and investment returns, you know, emerge along with other categories of much higher risk opportunities, I think it'll take off.
Jean?
Yeah, I think the point earlier about what seems risky is what you don't know. I started by saying I think the first step really is to educate and inspire, and I think by sharing our stories and trying to spread the word about what our experiences have been, that'll be a great first step.
And I would just share, even though this market isn't moving forward as fast as some of us would like it to, I continue to see consistent momentum. The Milken Conference, one example. Last year there were 2 sessions on impact social capital. This year there's 4 sessions. And I think I'm seeing that everywhere that I go, that there's interest. And I think it's the next-gen millennial interest that really, if we can figure out a way, as Russ talked earlier, with social media, to really catalyze that interest and perhaps build some products that these people can actually, in some small way, individually invest in, that will really help to move us forward.
Well, thank you all very much. Appreciate everybody's contributions.